The IRS reportedly mailed compliance alert letters to over 400,000 older homeowners across 12 states in February 2026. And if you own a home and receive Social Security, there is a strong chance one of those letters is traveling to your mailbox right now. These are not phishing letters. They carry official IRS letterhead reference CP2000 and LTR 5071C notice codes. And they focus on a specific mismatch the agency began flagging last fall: unreported or misstated income tied to property tax exemptions, homestead credits, and the way your Social Security benefits interact with supplemental income from your home. If you received one of these letters, or if you live in one of the 12 states I am about to name, you need to understand exactly what is happening before you respond. Here is the single most important thing I can tell you right now. If you are a homeowner over 62 receiving Social Security, and you claimed a state-level property tax exemption or homestead credit in tax year 2025, the IRS may be treating the value of that credit as unreported income. That means your federal tax liability could rise by $1,200 to $3,800, depending on the size of the credit and your total combined income. You have the right to contest this. You have the right to file a response showing the credit is excluded under your state's classification, but you must respond within 30 days of the letter's date, or the IRS will assess the tax automatically and begin collection. I will show you exactly how to respond, which form to use, and how to make sure you do not pay $1 more than the law requires. But first, you need to understand why this is happening in 2026. Because the reason goes deeper than a simple letter. The 12 states currently affected are California, Texas, Florida, New York, Illinois, Pennsylvania, Ohio, Georgia, Michigan, North Carolina, New Jersey, and Arizona. These are not random. They are the 12 states with the highest volume of senior homestead exemption claims filed in tax year 2025. The IRS cross-checked state property tax records with federal returns using a new automated matching system that went live in September 2025. Before that system existed, the IRS rarely reviewed state-level property tax exemptions. They did not have the tools or the staff. That changed last year. The agency received $3.2+ billion in new tax enforcement funding as part of a continuing resolution passed in late 2025. And a significant portion of that money went to data matching technology targeting what the IRS internally calls passive benefit discrepancies. That is their term for value you received from a government program that might, under certain conditions, affect your federal tax calculation, even though you never thought of it as income. Before I continue, if what I just told you made you uneasy, that's because it should. Most retirees are forfeiting between $2,000 and $5,000 every single year to IRS rules they never knew existed. I spent 28 years inside the system watching it happen. That's exactly why I wrote the IRS Senior Savings Handbook. 23 legal exemptions and credits the IRS publishes but never explains to retirees. And right now, everyone who gets it also receives my personal IRS deadline calendar for 2026. Every date you need to know. 1 page free. Link in the description and first comment. Don't wait until April to find out what you missed. Think of it this way. Imagine you have been shopping at the same grocery store for 20 years. Every week the store gives you a senior discount. You never asked for it. It just appeared on your receipt one day, and you have been getting it ever since. Now imagine the store sends you a letter saying that discount counts as store credit, and store credit counts as income, and you owe taxes on 20 years of discounts. And that is roughly what is happening to hundreds of thousands of senior homeowners right now. The property tax exemption you received from your state, the one you applied for years ago, the one that lowered your annual property tax bill by $800 or $1,500 or $2,400. The IRS is now asking whether that exemption created a tax event on your federal return. Now, I want to be clear about something. In most cases, state property tax exemptions are not federally taxable. The IRS knows this, but the automated matching system does not make that distinction cleanly. It flags the mismatch. It generates a notice, and then it becomes your responsibility to prove the exemption is not taxable income. The burden falls on you, not on the IRS, not on your state, on you. And if you do not respond correctly, or if you do not respond at all because you thought the letter was a scam, the IRS will assess the additional tax, add interest from the original filing date, and in some cases, apply a negligence penalty of 20% on top. This is not a partisan issue. This is not about one president or one party. This is about a federal agency that received a massive technology upgrade and aimed it at the easiest targets. People on fixed incomes who file simple returns and are unlikely to hire tax attorneys. I saw this pattern repeatedly during my 28 years inside the system. When new enforcement tools come online, they do not get aimed at the most complex evaders first. They get aimed at the highest volume of low-hanging cases. And right now that means seniors with homestead exemptions. The IRS Automated Under-Reporter Program, which generates CP 2000 notices, processed over 2.1 million cases in fiscal year 2025. That is a 34% increase from fiscal year 2023. The program matches information from third-party sources, your bank, your employer, your state government, against what you reported on your federal return. If you've ever received a letter from the IRS and had no idea what to do, you need my second guide, IRS Audit Shield, the Senior's Survival Manual. It breaks down the 14 most common IRS letters seniors receive, what each one actually means, and exactly what to do in the first 72 hours. Most people panic and make it worse. This guide tells you what to say, what to send, and what never to do. Grab it now at the link below, and it comes with a free bonus, my personal IRS call script, word for word, so you know exactly what to say when you call them. When it finds a mismatch, it generates a proposed adjustment. The letter tells you what the IRS believes you owe. It gives you 30 days to agree or disagree. If you agree, you pay. If you disagree, you must submit documentation. If you do nothing, the IRS treats your silence as agreement and sends a bill. Here is where it gets risky for seniors specifically. The CP 2000 notice is not a bill, it is a proposal. But the language in the letter is designed to look urgent and final. Many people over 65 read the letter. I see a dollar amount, panic, and either pay immediately or throw the letter away because they assume it is a scam. Both responses are wrong. Paying without reviewing the proposal means you may be sending money you do not legally owe. Ignoring the letter means the IRS will assess the full amount plus penalties and interest, and they will begin withholding from your Social Security check through the Federal Payment Levy Program without further notice. Let me tell you about Margaret. Margaret is 71 years old. She lives in Daytona Beach, Florida. Her husband passed away in 2021. She receives $1,840 per month in Social Security survivor benefits. She owns her home outright, a modest 3-bedroom she and her husband bought in 1993. She claimed Florida's senior homestead exemption, which lowered her property tax bill by about $1,900 per year. In January 2026, Margaret received a CP 2000 notice stating the IRS identified $1,900 in unreported income for tax year 2025. The proposed additional tax was $418 plus $34 in interest. Margaret called her daughter. Her daughter told her it was probably a scam. Margaret almost threw it away. She did not throw it away. She brought it to a free tax preparation site at her local library, where a volunteer explained that the notice was real, but the IRS was wrong. The homestead exemption in Florida is not federally taxable income. Margaret filed a response using Form 5564 with a written explanation and a copy of her Florida property tax exemption certificate. 6 weeks later, the IRS withdrew the proposed adjustment. Margaret owed nothing, but if she had ignored that letter, the IRS would have assessed $452, the tax plus interest, and begun collecting it automatically from her Social Security check. Now, consider Harold. Harold is 67. He lives outside of Dallas, Texas. He retired from a manufacturing plant in 2022. He receives $2,100 per month in Social Security retirement benefits, and he picks up about $6,000 per year doing small engine repair in his garage. Harold claimed the over 65 property tax exemption on his Texas homestead. His exemption lowered his school district taxes by about $2,200. Harold also did not report the full $6,000 in self-employment income on his 2025 return because he thought income under a certain amount did not need to be reported. He was wrong about that. The IRS sent Harold a CP 2000 notice for the unreported self-employment income and flagged the property tax exemption in the same letter. Harold's proposed adjustment was $1,740 in additional tax, plus $390 in self-employment tax, plus a negligence penalty of $426. Total proposed assessment, $2,556. Harold's situation is different from Margaret's because part of his mismatch is legitimate. He does owe tax on the self-employment income, but the property tax exemption portion of the notice is incorrect, and he has the right to dispute that portion while agreeing to the rest. Harold needed to file a partial agreement response, checking the box on Form 5564 that says he disagrees with part of the notice, and attaching a written explanation identifying which line items he accepts and which he disputes. Then there is Dorothy. And Dorothy is 74. She lives in Syracuse, New York. She receives $1,620 per month in Social Security. She has a small pension of $340 per month from a county government job she held for 12 years. Dorothy claimed the New York State STAR exemption on her property taxes, the school tax relief program that lowers school tax bills for homeowners over 65 with income under $98,700. Her STAR benefit saved her about $1,400 in 2025. The IRS flagged that $1,400 as a potential unreported benefit. But here is what makes Dorothy's case particularly frustrating. New York changed the STAR program several years ago from an exemption to a credit for many homeowners. If Dorothy receives the STAR benefit as a check, which New York now sends to many qualifying homeowners rather than applying it directly to the tax bill, the IRS matching system picked up the check as income. The distinction matters enormously. An exemption reduces the assessed value of your home. A credit check is a payment to you. If Dorothy received a STAR credit check, the IRS may have a legitimate question about whether she reported it. But even in that case, the STAR credit check is generally not taxable at the federal level. Dorothy still needs to respond and document the source of the payment. Now, I want you to ask yourself a question. Did you claim a property tax exemption, a homestead credit, a senior freeze, or any similar benefit on your home in tax year 2025? If you did, and you live in one of those 12 states I named, you need to check your mail carefully over the next 60 days. The IRS is still sending these notices. The February wave was not the last one. The agency processes CP 2000 notices in batches, and the next batch, targeting senior homestead exemptions, is expected to go out in April 2026. Here is what the IRS does not tell you, and what most tax preparers will not mention unless you ask. IRS Publication 525, the official guide to taxable and non-taxable income, contains a section on state and local tax refunds and credits. On page 14 of the 2025 edition, there is a paragraph that explains when a state tax benefit becomes federally taxable. The rule is called the tax benefit rule, and it works like this. If you itemized your deductions in a prior year and deducted your full property tax, and then your state gave you a refund or credit that reduced the property tax you actually paid, the IRS may treat the refund or credit as taxable income in the year you received it, but only to the extent that the prior deduction gave you a tax benefit. Read that again slowly. The key phrase is, to the extent that the prior deduction gave you a tax benefit. If you took the standard deduction instead of itemizing, the tax benefit rule does not apply. The state property tax credit is not taxable because you never claimed the deduction in the first place. And here is the critical fact. Approximately 78% of taxpayers over 65 now take the standard deduction because the 2017 tax law nearly doubled it. The 2025 standard deduction for a single filer over 65 was $16,550. For 2026, it is projected at approximately $16,900. If your total itemizable deductions, state taxes, mortgage interest, charitable contributions do not exceed that amount, you are taking the standard deduction, and the tax benefit rule does not apply to your homestead exemption. The IRS automated system does not check whether you itemized. It just flags the mismatch. This information is in IRS Publication 525, pages 14 and 15. It is also referenced in the Internal Revenue Manual Section 4.19.3, which governs the Automated Under-Reporter Program. That section instructs IRS examiners to verify whether the taxpayer itemized before applying the tax benefit rule. But the automated system generates the notice before a human examiner reviews it. In many cases, no human examiner ever reviews it at all. The notice goes out, and the taxpayer either pays or does not. That is, the system working exactly as designed, not to find the right answer, but to generate revenue from the maximum number of cases with the minimum number of staff. If you work with the SSA for any part of your benefits, you already know how hard it is to reach a real person. Average hold times at SSA phone service centers hit 47 minutes in February 2026. The agency has reportedly lost over 7,000 employees since mid-2025 through a combination of early retirement incentives and workforce reduction directives. Field offices in rural areas are operating on reduced hours. Some offices that used to open at 8 in the morning now do not open until 9:30 and close at 2 in the afternoon. If you need to verify your benefit amount for an IRS dispute, getting that verification letter from SSA can take 3 to 5 weeks by mail. You can request a benefit verification letter online at ssa.gov if you have a My Social Security account. If you do not have one, create one now. Do not wait until you need it. Here is your protection protocol. Follow these steps in this order. Step 1. Check your mail every day for the next 90 days. If you receive a CP 2000 notice, or any letter from the IRS referencing your 2025 tax return, do not ignore it and do not pay it immediately. Read the entire notice. Find the response deadline printed on page 1. It is usually 30 days from the date on the letter, not 30 days from the date you received it. If the letter sat in your mailbox for a week, you have already lost 7 days. Step 2. Determine whether you itemized or took the standard deduction on your 2025 federal return. Look at line 12 of your Form 1040. If the amount matches the standard deduction for your filing status, you took the standard deduction. Write that fact down. It is your first line of defense. Step 3. If you took the standard deduction, the tax benefit rule does not apply to your property tax exemption. Your response to the CP 2000 notice should state clearly that you elected the standard deduction for tax year 2025, and therefore the state property tax credit or exemption does not constitute taxable income under the tax benefit rule as described in IRS Publication 525. Attach a copy of page 1 and page 2 of your 2025 Form 1040 showing the standard deduction. Attach a copy of your state property tax exemption certificate or your county assessor statement showing the exemption amount. Mail your response to the address printed on the CP 2000 notice. Send it by certified mail with return receipt requested. Keep a copy of everything. Step 4. If you itemized your deductions and you did deduct your property taxes on Schedule A, the situation is more complicated. You may owe some additional tax on the portion of the exemption that reduced a deduction you already claimed. But even then, you only owe tax on the amount that actually gave you a tax benefit. If your itemized deductions barely exceeded the standard deduction, the taxable portion of the exemption may be very small or zero. IRS Publication 525 provides a worksheet to calculate this. You can also call the IRS directly at 800-829-8374 to discuss a CP 2000 notice. Hold times on that line averaged 32 minutes in February 2026, but calling early in the morning before 8:30 Eastern Time typically reduces the wait. Step 5. If you cannot handle this on your own, contact a volunteer income tax assistance site known as VITA or a tax counseling for the elderly site known as TCE. These are IRS-sponsored free tax help programs specifically for people over 60 and people with income under $67,000. You can find the nearest site by calling 800-906-9887 or visiting irs.gov and searching for VITA. Many of these sites operate through April 2026, and some continue year-round. If you live in a rural area and the nearest VITA site is far away, some sites now offer virtual appointments by video call. Ask when you call. Step 6. If the IRS has already assessed the tax and you did not respond to the CP 2000 notice in time, you are not out of options. You can file a Form 1040X, an amended return for tax year 2025. The deadline to amend your 2025 return is April 15, 2029, 3 years from the original due date. Filing an amended return allows you to correct the issue and claim a refund of any tax you overpaid. You can file Form 1040X electronically through IRS Free File or through most commercial tax software. If the IRS has already begun levying your Social Security check, you can request a collection due process hearing by filing Form 12153 within 30 days of receiving the levy notice. That hearing temporarily pauses the levy while your case is reviewed. And I want to be direct with you about something. I am not a licensed tax attorney. I am not a certified financial planner. I am a retired federal employee who spent 28 years inside the IRS system. I saw how notices get generated. I saw how disputes get resolved. I saw which taxpayers got relief and which ones did not. And the difference almost always came down to one thing: whether the person responded with documentation or whether they froze. The system is not designed to help you. It is designed to process you. But within that system, there are rules that protect you if you know they exist and if you use them within the time limits. That is what I would tell my own brother. That is what I would tell my own mother. Now let me bring this back to where we started. The IRS sent warning letters to senior homeowners in 12 states. Those letters are real. The proposed tax assessments in those letters are often wrong. Not because the IRS is trying to trick you, but because an automated system flagged a discrepancy it does not have the context to evaluate. You now know something that most people your age in your situation do not know. You know that the tax benefit rule only applies if you itemized. You know that approximately 78% of seniors take the standard deduction. You know that a CP 2000 notice is a proposal, not a bill. You know which form to use, which publication to reference, and where to get free help. That knowledge is worth more than any amount of worry. I put together a resource for people in exactly your situation. It is called the Senior Tax Defense Guide: 7 IRS Rules Quietly Draining Your Retirement in 2026 and How to Push Back. It covers the CP 2000 response process step by step. It covers the provisional income formula that determines how much of your Social Security gets taxed. Up to 85% of your benefits can be federally taxable, and most seniors do not know the exact threshold. It covers the Medicare IRMA-related surcharge that raises your Part B premium if your income crosses thresholds on a joint return, and how a single IRA withdrawal can trigger it. The guide is $27 and available at the link in the description below. You spent the last several minutes learning something the IRS does not go out of its way to explain. You learned how to read a letter that was designed to intimidate you into paying without asking questions. You learned where the rules are written and how to use them. That is not a small thing. In a system built on complexity, the person who understands the rules is the person who keeps their money. You earned that money. You earned that home. And you earned the right to protect both.